Welcome to our first Agency Masters webinar of 2024. So for those of you who don't know me or who haven't joined some of the previous webinars, I'm Steve. I'm one of the co-founders of the Agency Works, and I've been working with agencies for over 20 years now to hopefully help them improve their processes, become more efficient, and hopefully become more profitable. Now, as usual with these webinars, I rope in one of my colleagues who knows much more about the topic than I do, and today is no exception. So as we'll be delving into the often complex subject of accounting and finance, I've asked one of our senior consultants, Jenna, to join me, as Jenna has extensive experience working with finance teams and knows much more about this than I do. So thanks for joining me, Jenna.
No problem. Morning, everyone.
Do you want to give us a bit of background, Jenna, in terms of kind of what qualifies you to talk about this topic today?
Yeah, of course. So, like been said, I'm Jenna. I'm one of the senior consultants here at the Agency Works. I've been with the Agency Works for about 3 years now, supporting agencies on implementing Synergist and also supporting them on the additional element of revenue management that we're going to look at today. I am AAT qualified, and I've previously worked within finance roles and functions finance teams. So I am quite familiar with the process of RevRec and the terminology and everything that goes with it. It is a topic that comes up time and time again when we speak to agencies. It's one of those bugbears that it's just getting to grips, being able to manage it well within an agency. So yeah, thanks for inviting me to join, Vin.
No, thank you for joining me. You're much required. Right. So if you look back to when you perhaps were a smaller agency, the chances are when you finished a project, you sent the invoice, you got paid, and everything was nice and simple. But as you grow and you start to take on bigger projects, bigger clients, this isn't always the case. New bigger projects lasting several months or signing longer term retainers, receiving more upfront payments can play havoc with your balance sheet. So this is not ideal when you need a more accurate view of what's going on to forecast effectively and to track against monthly projects. So having worked with agencies for many years and speaking to lots of client services teams and some client service directors, they often get asked to produce revenue forecasts for the year, but they don't always understand why and how this may differ from a simple invoicing forecast. So it's definitely, as Jenna says, definitely something that most agencies get involved with, but there is still some mystification around it. Excuse me. So on today's session, hopefully we'll make things a little clearer. And what we're really looking at is what RevRec actually is, the benefits of accruals and deferrals and what that actually means, when to start thinking about revenue management, how to effectively allocate revenue, and how to get better understanding of profit per project. Now, before we crack on, there are a large number of you registered on this session, so we've had to make some assumptions. So some of you, like Jenna, may be fully fledged financial masters, but you understand the concept of recognizing revenue and you may be looking for recognition that you're doing the right thing. However, some of you may have heard the term discussed in the agency, but you don't fully understand what it means, or you might be asked by finance teams to do this, but you're not quite sure why you need to do it, or what impact it has on the agency as a whole. Either way, we hope the webinar will help make things a little bit clearer. Right, let's start with what it actually is. And here we have a nice definition from our friends at Investopedia of what revenue recognition is. A generally accepted accounting principle, or GAAP for those who work in finance, that stipulates when and how revenue is to be recognized. Right, well, that's nice and simple. What does it actually mean? And this is where, Jenna, I'm hoping you'll make it a little clearer for us and make some sense of this.
Right. So let's nail this together. Essentially, revenue recognition is a way for a business to show when revenue is earned rather than when they invoice. Some agencies may use cash accounting principle, others may use accrual accounting practices to show costs and revenue as they are incurred. Revenue recognition is an accounting principle. It's used to either bring revenue forward, aka accruing, so that it is shown on your P&L before work is delivered, or by deferring revenue, which means that you're delaying recognizing revenue until you deliver the work. So this is great for agencies who may have clients asking them to bill at year end so that the client doesn't lose their budget, but maybe you're not completing the work until the following year. So you've invoiced, but you don't know how much of that is profit because you've not incurred the costs yet. So the costs of time and purchases. The revenue would sit on your balance sheet until you then recognise it in line with your costs incurred. Accrued and deferred. So I mentioned them a minute ago. These are two accounting terms that you may already be familiar with. If not, don't worry, they're not as scary as they sound. An accrual brings revenue forward, allowing you to recognise it before you invoice the client. Deferring is where you invoice the client before work is carried out and then recognise revenue at a later date as and when work is delivered. A common scenario that we see with agencies is that a client has maybe a quarterly or an annual PO for their budget. The agency needs to invoice them in full, but we're not sure at that point where or on what work that's going to be delivered. So you'd raise the invoice to the client, but defer the revenue. The revenue is then released or recognised when the work is delivered. Hopefully that's starting to feel a bit easier to understand. This on screen is an example of how Synergist can help to manage revenue recognition. This screen grab here is from the billing plan tab. Some of you may already use the billing plan tab to help forecast when you plan to invoice a client. This is with the revenue management module turned on, and it shows that the client has been invoiced your 15K in February with the recognised value at 0. The revenue is then forecast to be recognised as work is delivered during March, April and May. The billing plan page enables you to forecast when you're planning to invoice your client, so in that planned column, and when you plan to recognise the revenue in that recognised column. There's a notional cost column there as well. That's also a way of entering planned external costs into your forecast. All of that combined will then give you a gross profit forecast.
Great, thanks, Jenna. Hopefully that makes things a little bit clearer. So Jenna's explained what it technically means and what it might look like, but why should we do it? So aside from pleasing the finance team and the impact it has across other agency processes and benchmarks, this is typically an example of a report that we may see, and some of you may do this already. You will have your clients and your prospects on the left-hand side of your spreadsheet. You'll have the months across the top, and then you'll have the amount quoted in the corresponding month of when you're likely to win the project. So this typically kind of lends itself to be a kind of sales forecast. Then we'll see when we can invoice the project, and that's your billing and cash flow forecast. Potentially, as Jenna said, when third-party costs are likely to be required, which is your cost forecast. And then when we need to deliver the project, which kind of lends itself or leads into your capacity forecast. And based on the above, what we also need to include is when we can recognise the revenue, which is your revenue forecast. So why would we need to forecast when the revenue can be taken separately from other metrics? Let's look at an example. So you might have had a great month and you're able to bill a bumper amount. Let's say you're billing, I don't know, 200K, which on paper looks brilliant, but you might not have delivered the work yet. So you've got the money, but you actually know how much of that revenue is actually profit. So this is potentially a false picture, and often agencies want to avoid having lumpy months. Therefore, we may invoice the project in January, but we might not be starting to deliver the work until, say, February and March. So this would have an impact on both project and period profit reporting, as we don't want the 200K's worth of sales in January if the majority of the work and therefore costs will be delivered in later periods. So that 200K may be taken or recognised in chunks and can be aligned with either delivery milestones or maybe as the work is delivered. And we do this as it has an impact on the reports that you've seen listed on the slide. And if we don't, there is a danger that we won't be reporting accurate figures. Okay, so that's kind of why we'd look to do it. The other big question we get asked is when to do it. And I suppose in a way, there's no kind of real right or wrong answer to this, and different agencies recognize revenue in different ways and in different periods. Ultimately, the decision on what to recognize or when to recognize can also be driven on how an agency wants their accounts to look in a given period. But either way, it's always a good idea to have the process in place, and particularly as you grow and it starts to become more essential. So you're taking on bigger jobs and bigger clients, which generally means a shift in the way you invoice and receive payments. As Jenna said, you might also as well have a client that asks you to bill them up front, because if you don't, there's a danger that they may lose their budget. But as soon as you start invoicing in advance of completing work, you need your process up and running. So getting paid large amounts of money up front can seem brilliant in theory, but until the money is earned or recognized, you need to manage it carefully. Otherwise, you're consistently playing catch up and could end up operating at a loss. However, once you get into the right habits, you'll be able to effectively allocate your revenue and also have a clear understanding of profits per project. Ultimately, what we're trying to do is avoid the headaches and reduce the amount you're spending on paracetamol each month. Okay, so once we've agreed on the process to cover these situations, how do you actually go about doing it?
So, how to do revenue recognition. Like Vin said, you can do this a few ways. One option that we do see is that you use a good old spreadsheet, tracking that pot of money, itemize what's been spent with dates and details, balances remaining, meaning that you'll then use that spreadsheet to calculate how much revenue, costs that you're allocating to your profit and to the relevant period each month. But that does rely on someone manually tracking, remembering to add every single detail. It's clearly a mammoth task, okay? Unless, of course, you've got an amazing agency management system that's going to help you manage that process, such as Synergist. Using Synergist, we can help to automate that process, meaning that you can create your sales invoices, allocating revenue accordingly by deferring and accruing on those sales invoices. Those transactions can then be posted directly into your finance software, such as Xero, QuickBooks, Sage, posting the balances either directly to P&L or to your balance sheet. So you would say, raise a sales invoice, deferring the revenue in month 1. You're invoicing up front. You're not starting the work until later on. So this will post the value directly to your balance sheet, deferred revenue nominal code. In month 2, when you start to want to recognize some of that revenue because you've done some work now, you've incurred some costs, people have logged timesheets, you can then release the revenue from deferred and release it into your sales nominal. There's even an option on Synergist to base that upon your WIP, okay, so your ticked off time costs. I know that a lot of you on the webinar this morning are existing clients. If you haven't got this feature activated, please do reach out to us. Once activated, turning it on does switch up your reports, your dashboards, like you saw with the billing plan page. It adds in additional columns, and Synergist will start to report on recognised revenue as opposed to invoiced revenue. So it's definitely worth getting to know the process before you switch it on. Revenue management module in Synergist is a really powerful tool, and I've worked with many agencies now on this. It does take away that headache that Vin mentioned, the headache of manual spreadsheets. Someone overwrites your formula, you forget to put your time in for a previous month or a cost in. It does the journal entries for you, and it just makes your life easier. If you are a Synergist user and do want to watch a previous webinar on revenue management, drop me an email, send me a note on LinkedIn, and I'll get a copy of that recording sent out to you after this. So some best practice on us, consistency on how you're looking to recognise revenue. Are you going to base it upon your WIP, so your work done, timesheets, costs, recorded to date? Or are you going to base it upon how far you are along with a project, so a percentage complete? Check that you're not overstating and over-servicing. So if you're basing it upon WIP, just be mindful to keep an eye on time recorded on the job compared to your estimates. Check that people aren't going over and you're overstating your revenue prior to the actual work being delivered. Reconcile at month end. So if you've got it turned on in Synergist and you are using the revenue management module, just use the revenue management report to reconcile to your balance sheet. Again, another headache just gone. Your balance on that report in Synergist should equal to the balance on your accrued and deferred balance sheet nominals. So you've got that month-end reconciliation already done for you.
Great, thanks, Jenna. Some top tips there. Just before we continue, just in terms of for people on the webinar who may not be doing this, in your experience and with the agencies that you've worked with, how many are recognizing revenue or managing this process in their agency, would you say?
More and more. So I'd say 80, maybe 90% of clients that I work with are all doing revenue recognition, whether that's in a spreadsheet at the moment and they're looking to move into using Synergist. But yeah, certainly more and more clients are using it.
And why would they be using it? Why do you see more agencies using it than previously?
I think it's size of agencies and the size of projects is key. So bigger projects, maybe longer projects, bigger retainers where you are invoicing monthly, but you don't actually know what work is going to be delivered for that retainer. Clients also asking to be invoiced up front, particularly at year end. So in December, you're asked by a client, invoice me ready for the next year so that they don't lose their budget. Yeah,
that's something I come across more and more as well, but useful for people to know that they're either doing the right thing, or if they're not, then perhaps they should be looking to do that sometime in the future. On top of Jenna's top tips, I have some takeaways from today's session that will hopefully help as well. We typically do, if you've joined previous webinars, we typically do 3. Today, luckily, we've done 4 because I think it's a more kind of complex topic. So my 4 top takeaways from what we've discussed today are: A, avoiding lumpy months and trying to remove those spikes. So this will help you look kind of more consistently profitable, which is good if you're looking for investment or perhaps looking to sell, but it also gives you kind of general peace of mind as well. Second thing I'd look at is the using this on bigger projects. So looking to spread over several months. So especially if we've mentioned, if you're being paid up front or if it's been delivered over a longer period of time, that's something that you should look to bring in. And then number 3, once you've decided on a process of recognizing revenue, this may be manually in Excel or accounting systems, or you may look to automate the process using a system like Synergist to make things easier and give you less headaches. And then finally, communication with the team. I think this is really important. This isn't just a finance principle or a process, but it's something that has an impact across the whole agency, and we touched on before, particularly when it comes to looking at things like profitability reporting. Okay, so that brings us 21 minutes past the hour to the end of the session. We said that we'd try and give you some time towards the end to grab a cuppa before your next session. Hopefully you'll find some stuff useful today. We've covered quite a lot of a complex topic in a short amount of time. So as Jenna said, if you want to talk to us in more detail about this or introduce this to your agency or your Synergist system, do reach out. Our email addresses are on screen. You can find us via LinkedIn. We'll also be sending across a copy of this recording of this webinar this afternoon, so you can share it with colleagues who are unable to attend. And if you enjoyed this session, the next Agency Masters session is on make or break utilization rates. And again, we'll be pinging you details of that later today. You also might have seen that we're on YouTube alongside with our popular A-game series. So if you've got 20 minutes or so spare, do go across and have a look at the previous webinars we've done. So thanks ever so much for joining us. Finally, a big thanks to Jenna. Thanks for demystifying some of that for us, and hopefully it's a lot clearer for those of you who joined today. Have a great day, everyone.
Bye.